We're going to talk about a subset of the commercial real estate trends and what's going on in national capital markets. Joe, do you want to do a quick intro?
Absolutely, Lon. Thanks so much for having me join you. I always enjoy these conversations that we have. I think of them like a fireside chat where we get to tell everybody what's going on. And again, my name is Joe Massey with Castle & Cook Mortgage, and have worked with Lon at Your Castle Real Estate for, 12, 13 years now. Been working with Ironton Capital for, 3 or 4 years now. And my job is to be a resource for financing. So anything that you need for residential financing for your primary residence, investment properties, second homes, I look at a lot of transactions with Lon and hopefully can provide some insight on interest rate, financing terms, things like that as we dive in today. So Lon, thanks so much for having me, man. Always appreciate it.
Glad that you're here, and just dive in at any time. And then on the right hand side of your screen, you'll probably see a chat box. If you've got questions for us, just drop those in and we'll try to weave in your questions as we go. So how many of you guys would like to know how to get the pulse of the capital markets for both lending and sales trends? How many of you want to have a sense of where are we at for distressed properties for commercial now and what's likely to happen next? So what we want to do is prepare for tomorrow's shifts, which is why the professionals are always poised and ready to act and snag opportunities. So if I can give you the background information so that you can feel like you've got the confidence to act when that good opportunity does show up, it'll save you a lot of distress in the decision-making process. What you find is a lot of people are making decisions based on what they hear on CNBC or the coffee shop, and they don't know about the cycles of real estate investing, and they're making decisions in a vacuum without all the information. So I've got a little love letter from my attorney. I'm not a financial or an investment or a tax advisor. I've got a background in finance and I studied the market. I'm going to share what I think is going on, and I'll give you all the sources of the information that I've got. You're going to see a lot of words like will, may, should, expect, plan, seek, and those are all just based on our professional judgment. But you'll want to share anything that we have in this with your financial advisory team to make sure you agree with our analysis and that you've got a good set of understanding of how this fits into your overall financial game plan. Most of you on here, I think, probably know me. I have been in commercial real estate for over 20 years. I built a large brokerage from scratch, a title company from scratch, and I've done a lot of development over the years. Got a couple other guys on the investment team who helped me evaluate projects to invest in. Collectively, there's just about 3.5 people full-time just looking at prospective deals for our investors to invest in. So we got multiple paths for helping people go from an active investor to a passive investor because no one path really is right for everybody. So hopefully we can be a resource to you guys as you go through your investing career. So here's some of the key messages I really want us to focus on today is that the commercial real estate transaction count is off about 60% from pre-interest rates increasing about 2 years ago. And that a study just showed that there's $260 billion of dry powder. And by that, I mean cash just sitting on the sideline. It's been earmarked for investment in commercial real estate, but the decision maker doesn't think like right now is the right time. The second thing is that the number of housing starts is off from the peak in 2021, but the number of apartments under construction is on a massive build right now. And that's going to have some pretty significant impacts on the rental market nationwide. And I want to explore those in some degree of detail with you guys today. Distress, I think that when we started having the spike in interest rates, we all anticipated there would be a lot of distressed properties on the commercial side. And that has not happened at a broad scale yet. We'll talk about what that means and what's likely to happen next. And if we have time, we'll talk a little bit about construction costs finally slowing down a little bit. So diving into this a little bit, first quarter of 24, real estate investment was down 10% versus first quarter of 23. Overall, since pre-COVID, we're off about 35-40%. If you survey the people who get to make decisions about what sort of commercial real estate to buy, multifamily is still the most preferred category. And what you'll see over a broad business cycle is multifamily usually has the lowest overall average return compared to office, warehouse, retail, or mixed use. But you'll see that multifamily has the least amount of volatility. Segments like retail, they might do really well in a boom economy. They might really suffer during a recession. So it's a little bit of a roller coaster ride. Multifamily is much, much less volatile. It's much more predictable. And I think that's why in times that are a little bit scary, multifamily is kind of the safe harbor that people tend to drift towards. MF, multifamily, cap rates have been increasing So over the last year, they've gone from the high 4s to the low 5s. And this would be for institutional grade assets. So if you're BlackRock purchasing a 300 unit community that's relatively new in a great location, being well operated, like a 5.25 might be the cap rate that transaction would get done on. We think in talking to the people who do allocate capital that lack of interest rate clarity is the key gating factor that's slowing people down. Let's talk a little bit more about dry powder. Most of it is opportunistic. So that would be people who perhaps don't have enough cash to get to their next refinance and they need a little bit of help and they're willing to give up a lot relative to the amount that they need for a white knight to come in and save them. Value add would be a property that perhaps the owner has been neglecting the maintenance and the rents are below market and someone needs to go in and renovate the property, renovate the common areas, put in a new management team, and then raise the rents to market. Distress would be something that's maybe in foreclosure or pre-foreclosure. Core and Core Plus are really nice properties operating really well in nice locations. So traditionally, when you think about investing in real estate as a less sophisticated investor, Core and Core Plus are usually what you're looking at. So this is where the cash on the sidelines is at. So we think, in talking to some sponsors, that a lot of cash is going to get released pretty soon here. And the evidence I think that's most obvious for this is that you probably saw in the Wall Street Journal a couple of weeks ago, the largest institutional investor, BlackRock, decided that they're going to put $10 billion into buying a portfolio of really nice multifamily properties. And there was a comment in there saying that we think that if we're not at the bottom, we're close enough to it, it's time for us to start buying. And we see a lot of upside on that. You may have seen also in KKR, another large private equity fund on Wall Street, that they were making the case that investing now with the current interest rates and the current set of assumptions could result in double-digit returns. And it's probably time to really start getting back into the market. What's really happening here is that KKR and BlackRock and large institutional funds like them on Wall Street have raised multiple billions of dollars, and they made commitments to their limited partners that we're going to raise this money and we're going to have it deployed within this amount of time. And if we don't have it deployed, we have to give it back. And no one running a fund is going to give capital back to an investor. They're going to find something to invest in. So for many of these guys, they may have a 3-year window in which they've got to deploy the capital, and they're 2 years into the life of their fund. So they're becoming a little bit more relaxed about their assumptions. They're being a little bit more willing to say maybe 11% is good enough. Maybe it doesn't have to be 13%. And they're trying to get the cash out the door. I think once you see a few more announcements, like we saw with BlackRock with this $10 billion acquisition, you're going to see quite a few more of them coming along. Joe, anything to add on to that? I feel like I'm just talking a lot here.
No, I think you're spot on. I really like what you said. There's a lot of dry powder on the sidelines, and this puts these guys under pressure. These guys, BlackRock, KKR, big institutional investors, they're under pressure that their people are hollering at them, hey, we want a return. What are you doing? And they're like, well, we wanted to have really safe or really good investments. Now we might ease up a little bit on what we're looking for because the market is becoming, I think, a little bit more stable in what is the medium-term outlook. Hey, we're all adjusting to higher interest rates. Can we make deals work at that? And we're going to stop hoping that interest rates are going to go down. And they're saying, okay, it's time to re-enter the market. So I agree 100% with what you're saying.
Right at this next chart. This is written from the point of view of commercial loans, but I think there's a huge analog to the type of loans you work on, Joe, and on how difficult are the lending standards. And you can see from, say, 2018 through the first part of 2020, pre-COVID, it was just like a normal lending environment. And then during the first half of 2020, when we were all in panic mode about COVID, nobody wanted to lend because we weren't sure, how much impact is this going to have on the economy? And then we found out that, well, maybe COVID wasn't going to kill all of us and the lending standards eased. And then, Joe, when did the mortgage rates start going up? Was it sometime in 22, first quarter or so?
March 15th, 2022. So it correlates exactly with this chart. So March 15th of 22, rates crossed over 4%. Well, residential rates crossed over 4% for a 30-year fixed. And so it correlates exactly with this chart that you see lending standards tighten because interest rates go up. Affordability becomes a challenge, whether that's commercial or residential, and banks want the borrower, whether it's a commercial fund or a resident buyer, they want the borrower to borrower to be more well qualified in order to handle those higher interest rates.
I think a lot of this is that, banks need to maintain a certain amount of liquidity. So if they're normally getting, let's say, 10 loans to pay off every month, they may want to initiate 10 new loans at about the same size, so the amount of cash just sitting in the bank stays relatively constant. What they don't want to do is find themselves in a situation where maybe only 5 loans are getting paid off as opposed to the historical 10, but they're still writing 10 new loans because they would use up their cash really quick. So
That's
I
right.
think what I see here, maybe you can help me out, Joe, is that at the onset of the spike in the interest rates, I think a lot of lending committees, particularly at local banks, might have said, our normal payoff schedule to get money back in the bank from paying off a loan might slow down. We've got to slow down how many new loans we issue. So the way we're going to do that is we're going to cherry pick the very best loans and tighten our standards. Do you think that's the mentality?
You're spot on. So what we call that is prepayment speed. So, if we're going to make a loan, what are we going to anticipate that it's going to pay off? And when rates go from 3% to 7% in a relatively short period of time, let's call it 12 months, that extends prepayments. Loans stay on the books longer. And exactly what you said, if we're issuing the same number of loans, we're going to run out of money. So how do you slow down the number of loans you're issuing? Have tighter underwriting requirements, which serves 2 factors. Number one, you're only making the very best loans, so these loans are going to stretch out a little bit longer. And number 2, you're going to make more money on these loans because they're going to be at higher interest rates. So both of those things slow down volume, which is probably a smart thing if you're a bank and you've got a limited pool of cash.
Yeah, the other prudent thing that a loan committee would do is they would say, we have to set aside a certain amount each quarter for loan loss reserves. And that's kind of an arbitrary number depending on your outlook of where the economy's at and the quality of your loan portfolio. So I imagine early on when interest rates spiked, you'd want to err on the side of conservatism and set aside more for your loan loss reserves, which means there's less money available to be put out in the form of new loans. But what's really happening is that the number of losses and foreclosures has been less than we all feared, at least from what I'm reading in the Wall Street Journal, and that pendulum might be swinging back the other way. And if we decide, hey, we're not going to have all those losses, I can take some money out of that savings account and deploy it. Maybe I can make a few more loans. Do you think that might be a factor for easing as well?
100%. Yep. We're not seeing, a massive wave of foreclosures. You and I talk about that every day, that folks are concerned about that. It's not coming true. And banks are saying, hey, we're not going to see a massive wave of foreclosures. We've got this money set aside. Let's put it back out in the market. So you're spot on.
So I guess my anticipation is that the last 2 years has been an environment where the banks are going to cherry pick the very best borrowers, the very best projects, and they're not going to take any risk at all. And now that there's a couple different drivers of why there might be capacity to make more loans, there might be a little bit more competition between the banks to attract those loans to them versus a competitor. So maybe the terms will be just a little easier. Maybe the rates will be just a little lower. Are you seeing any evidence of that happening yet, or is it still just a little too soon?
It's a little too soon, but we're seeing it on the horizon. Yes, we're seeing that, some banks are saying, hey, we're thinking about rolling out XYZ type of product. We're thinking about loosening guidelines. So hasn't happened, but looks like it's going to happen.
Excellent. Well, I've got a chart here on interest rate ranges for commercial loans, and I'm going to talk about office. I've got an office building. If you guys are in the Denver area, the Denver Tech Center, my loan is going to expire in April of next year. I'm currently just enjoying this rate of 3.75%. And I was talking to actually Slack Capital today to find out if I was to refinance that today, what kind of rate would I be looking at? They told me probably 6.5. If I went back to my small local bank who's got the loan right now, it'd probably be at 7.75. So what's been interesting is that the spreads between the non-small banks and the small banks has been getting bigger every time I look at this each quarter, which is good for me because that's something that's going to be my reality here at fourth quarter this year. So 6.5% sounds a lot better than 7.75 does. So the capital markets, they're tighter, but they're not as bad as they may have been a year ago. So what we're probably going to see is that the loan to value on construction and purchase is going to drift up a little bit. There was a period of time where banks wanted more cash in the bank. So they would say, look, we're going to do this loan for you. Let's say the loans would be $10 million, just to make the math really easy. But we want 10% of that amount deposited in the bank. So you can either move all your operating accounts over here, or maybe you have to put $1 million in a certificate of deposit with the bank as part of us giving you this $10 million loan. So it's not quite the same thing as increasing the down payment, but it has the same dampening effect for a developer or a buyer, in that instead of needing, let's say, $3 million down on a $10 million purchase, maybe I need $3 million down, plus I need $1 million in the bank at making a certificate of deposit. So actually my cash outlay now is $4 million to do this transaction. It seems like we're seeing the first couple steps of that easing up just a little bit.
And one really important point I noticed there, you can go back one slide, Lon. A lot of banks in the past 6 to 12 months only working with existing clients, not taking on any new borrowers. When there's times of uncertainty, they're saying, hey, I don't want to talk to a new guy that I have no history with. I want this client who's been here with us for 10 years. He's done 7 projects. We've gotten paid back every time. We're seeing a lot of that in commercial, that they really want a known quantity, which just reiterates more than ever, it's important to have a great relationship with your commercial banker.
Absolutely. And it doesn't matter what size loan you're doing. So one of our very largest sponsors that we invest a lot in at Ironton Capital, they build for 250 to 300 unit apartment complexes that they'll end up selling in the $60 million range. So they're substantial projects, and they've got a portfolio of like 40 of them that they're working on. So it's a couple $1 billion. And their banks tell them the same thing. You know, the existing relationships they've got are the easiest places for them to go to get more capital. And trying to start a new relationship with the bank right now, it's really an uphill march.
Yeah.
So there used to be an index called LIBOR, the London Interbank Offer Rate, that short-term loans were based off of. We have something now called SOFR, the Secure Overnight Fund Rate. That's been around since about the time that COVID started up, actually. So a lot of commercial loans are priced on SOFR. So there'll be whatever the SOFR is, which is currently like 5.25, plus a premium or a spread, say 350 basis points or 3.5%. So if you're in Hill Point, you're borrowing at 5.25. You pay a 350 premium, you're paying 8.75% as your all-in rate. So we're expecting to see, as the Fed starts cutting short-term rates, which may happen a little bit this year, probably a little bit more of next year, we'll probably see SOFR follow along. And for all of our commercial investments, we'll probably see improvements in cash flow that follow shortly behind that. So from a summary standpoint, from a capital market summary, it's not easy to sell multifamily right now. So what the seller wants and what the buyer's willing to pay is more of a gap than historically you observe. So it's not as easy to get a transaction done as it would be historically. That's what I mean by that. So for the lender, the loans aren't getting paid off as fast as expected, and that constrains the amount of new loans that they can write. And if they're going to write a smaller number of loans, they're going to go with the people they know and the very best projects. Now that's easing up, but it's nowhere like it was pre-COVID. We are finding that the early phases of commercial real estate distress initially really alarmed loan committees, led to a lot of caution, and now we're seeing the world's not going to come to an end. We're seeing a little bit more flexibility as a result of that. The amount that's being asked for as a deposit to be dropped into a CD, that pressure seems like that's going away first. So that's really great. I think this is a lot of herd mentality. Nobody really wants to be the first bank to say that, hey, we're going to have easier loan standards. They all are very incremental. None of them want to stick their neck out. But I think as we see more and more banks make the initial first step, you'll see more and more of them follow. Joe, any other thoughts on that?
I agree 100% with that. It's like a game of chicken. Who's going to blink first, right? Who's going to say, all right, we're going to loosen our standards? Well, Lon, what are you going to do? We're not loosening our standards. Joe, what are you going to do? Well, I'm going to loosen my standards if Lon loosens his, right? And so you get a little bit of the herd mentality. I 100% agree with that. And I don't know if there was a point on here, but I think you touched on it verbally. We are seeing particularly development loans that are taking longer to pay off. I see it a lot in fix and flips, that somebody's buying a property and they thought they would have that loan paid off in 3 months, and it's stretching out to 5 to 7 to 10 months. So some of the hard money lenders and other, mid-sized lenders, they're seeing those terms stretch out, which is exactly what you said, gives them less capital to redeploy.
Yeah, it definitely puts a damper on things. Medium term, there's going to be a glut of apartment development. I want to talk about that in quite a bit of detail in a minute here. Let's just go through those slides. I think it'll be a lot easier for me to do it this way. The quick answer is that there's a lot of new apartments that are going to deliver over the next 18 months. It's going to disrupt the rental market. There's nothing in development behind that, and it's going to have a very favorable impact on multifamily in the medium to long term. So you're going to just ride through some turbulence, but you'll have a good payoff for doing it. I'm shocked. I'm 21 minutes into this, and no one has written a question. So if you have any questions, jot them into the chat section. If we had 2.5 or 3 hours, I'd be able to talk the whole time about really interesting stuff. I'm just going to tell you right now, it's very difficult to underwrite the development of a new apartment complex. I could walk you through this math on this chart, but just for the moment, take my word for it. If we run out of things to talk about at the end and you're curious, let me know. And this is one of the things I could go back and go with you if you want me to. So, something important to know about multifamily that's very special is that there's what's called agency debt. And if you're not familiar with that, that's Fannie Mae and Freddie Mac. So the Federal Housing Finance Agency is most well known for being a backstop for residential mortgages. Joe, can you give me a paragraph on that? Because you'd be able to explain it better than I can, probably.
Yeah. So, when you're going to get a loan, whether it's for your house or whether it's for a multifamily, Fannie Mae and Freddie Mac underwrite and securitize 70% of the market. And you might not even realize it. You might be talking to Wells Fargo, but you don't realize that the underlying securitizer of that is Fannie Mae or Freddie Mac. And that's true in commercial multifamily as well as just your single family home. And so they have a lot of availability to lend out right now. And there's a lot of appetite for bonds for single family homes or multifamily from Fannie Mae or Freddie Mac because they have really good underwriting criteria and a ton of historical data to help them write really good loans.
So they're the force behind almost all residential, but what people don't realize, they're also a giant force behind multifamily. And there's no analog to this for office, retail, or warehouse. And this is one of the reasons why it's a little bit less scary to invest in multifamily, because if the local bank is not interested in investing with you, a lot of times the Fannie Mae and Freddie Mac guys will do a large loan for your apartment complex. So they have loans on very favorable terms. They're not easy loans to get. They've got a very specific buy box. I've actually gotten one of these loans myself personally. It was the most red tape of any loan I'd ever done, but it was a great rate. It was fixed for 10 years. It was non-recourse, which was all very, very exciting. And the guy who bought the building from me could take the loan as well. So this is still out there providing liquidity for buyers on the multifamily side of the market. So I want to make sure all of you guys still knew about that. So let's talk about housing starts. On the multifamily side, you can see that from our peak, so the annualized rate, these are in thousands. We were floating around 600,000 starts on the annualized rate, and now we're down to 300,000 starts as an annualized rate. So our number of multifamily starts has been cut in half over the last 15 months. And I anticipate when I'm talking to you a year from now, you're going to see this is going to be down about 70%. The reason for that is that costs have gone up a lot for construction, both labor and materials. Land costs have gone up. And the challenge is that the rents are relatively flat in most markets. So with higher construction costs, flat rents, and of course the cost of borrowing is up a lot, you just can't get the math to work to say, I want to go build a new apartment complex. So the number of new apartments under construction is down by quite a bit. So this is the opposite chart. So this chart shows you what's getting started. And you don't build an apartment building in a day. It takes a little while. This shows you the number that are being completed. And you can see in 2024, the number of completions is expected to be just shy of 700,000 units. Last year, we delivered just over 400,000 units. So that's about a 55% increase in deliveries this year. You can see the deliveries in 25 will be off by 31%, and the deliveries in 26 will be off by another 50%, and then it'll be relatively stable after that. So the reason for the timing of this is that if you rewind in your brain, we saw really strong rent growth in 19, 20, and 21. And the mortgage rates for both residential and commercial at that time were ultra low, because when COVID started up, the Federal Reserve did everything they could to flood the market with liquidity and that resulted in ultra low interest rates. Now, with very, very low interest rates, it's very easy to get a development project to pencil out on paper. And then you can go to the bank and say, here's how much money you're going to make. Here's how safe this loan is for you as a bank. You're not taking much risk. Why don't you give us this money? And they'll say, yeah. So the deliveries we have in 2024 are projects that were probably approved in 2021. They broke ground in 22. And then 24 months later, they're being brought onto the market as a new property ready for tenants today. Today, the rents are flat. The rates are really high. The construction costs are really high. You go to a bank saying, I want to build. The bank says, no, I'm not going to do it. So this is why you see the forecast of 26, 27, 28 being so low for deliveries, because it's so hard to get stuff approved right now. There's this 2 to 3 year lag effect. Does that all make sense?
I think it makes a ton of sense. Yeah. And I think that this makes a lot of sense that 25, 26, when were those projects underwritten? 22, 23, when did you see interest rates going up? 22, 23. It's hard to make them work.
Yeah. So if you understand this one chart, you'll understand the dynamic of the multifamily market for the next 5 years, because this is the key to unlocking it all in your brain. So looking at housing starts, building permits on the right-hand side, you can see the red dot. January is off 24% from prior year, and all this year has just been in the basement. So we expect that the reduction in multifamily starts will get worse before it gets better. What does this mean? Well, before COVID, we had a structural shortage in the housing market where we didn't have enough units. I don't know if I've got this chart in here or not. I may have it. We have been building fewer homes and rental condos and apartments than required relative to our population growth for about 25 years. And as a result, there's more demand, there's more housing that would be, people would take more housing units if they were available at an affordable price. So the slight oversupply that we've got in new apartments coming online in the next 18 months is going to get absorbed relatively quickly, but we've got this giant undersupply of new units after that. So rents are going to be soft for 18 months, and the rents are going to take off after that, most likely. So any questions on that? Put them in the chat box. Otherwise, I want to talk about distress really quickly. You guys are a very easy audience. I don't believe it. I imagine you're saving up a lot of questions. I'm going to get a deluge in a second here. So there's an investment bank. Morgan Stanley estimates there's about $8 billion in commercial real estate distress assets. That sounds like a big number, but there's about $2 trillion worth of commercial real estate. So 80 billion on 2 trillion is like 2%. It's not very much. 98% of commercial real estate is not in distress. The number of delinquencies is up about 30%, up to about $17 billion. So again, on that, $2 trillion, so that's about 1% of the people are behind. Office has more trouble than anybody else. Multifamily, if you went back to 21 and early 22, when the mortgage rates were really cheap, we were selling institutional grade apartment complexes on 4 caps. Now they're trading in the low 5s. So cap rates have gone up, but they've not gone up nearly as much as the interest rates have. So what's going to trap some people is if they bought an apartment building, either to construct it from scratch or to do a major renovation on it, and they got a variable rate loan when the rates were really cheap and it was easy to get loan committee to approve your loan, and you locked it in, say 20, 21, or the first couple months of 22 before the interest rate spiked. You've got a situation where you built your business case on having 4% money, and now you've got 9% money. It's going to catch some people. So that's working its way through the chain. So you can see in total, we're probably going to have about $300 billion worth of distressed assets. The amount that are in distress currently is like 70 billion. So probably a good 2/3 of what will eventually become a distressed commercial asset is in performance status today. But, let's pretend, let's say you're my office building in the tech center. That rate is locked until March or April of next year. So I have no problem with cash flow now. It turns out I'm going to be okay after my interest rate reset, but we're going to go from being a cash flow asset to being kind of like a break-even asset, which is really a buzzkill. So I'm not going to be a distress asset, but my limited partners aren't too excited with me on it either until we do a few things. We've got a good strategy for managing it.
You're going to be an annoyed asset owner, right? You're not distressed, and you're not happy. You're just irritated that you're not making as much money as you used to make.
Yeah, exactly. It's a first world problem, and I wish I had a chart for that, Joe. That's a really good way to say it.
Yep.
So you could see that the office percentage of stress is much higher than it is for, say, multifamily or industrial, which probably arises as a surprise to absolutely nobody. If we had time, we could go through a typical scenario of how someone would find themselves in this situation and what it means for them. I'm not going to spend time on that now. Who's in the most pain? Mostly speaking, it's people who bought in mid 21 to early 22. So they bought at the top of the market at the worst cap rates for a buyer. They almost all got floating rate debt because they thought rates would go up a little bit, not a lot. And they bought right before everything really changed on them. Those will be the guys primarily who go into commercial distress. So,
Can you go back one slide?
Yeah.
So the very last bullet, punishing increases in insurance and property taxes. I think
yes,
one thing that we focus on so much, and I talk about it every day, is interest rates. People are like, man, I can't get anything to cash flow because the interest rate is so high, and I'm looking at this property, that property, and we forget that just simply the fixed cost of owning a property has gone up as much as 100%. We're seeing insurance double and property taxes up 50% over a 4-year period in almost all asset classes. And we forget, even if you pay cash, you're not cash flowing nearly as well today as you would have 4 years ago because of the fixed cost of owning the asset. I think that's one that gets glossed over sometimes because we're all focused on the biggest number, which is interest rate, but insurance and property taxes, it's tough to pass those over to a tenant or pass that along to a tenant when they've got a 5-year lease or a 10-year lease.
Yeah, I'm so glad that you brought that up. For this example, office building that I own in the tech center, I paid $3.5 million for it. It's about 30,000 square feet. My property taxes have doubled from 45,000 to 90,000 in the time that I've owned this building for 4.5 years, and my insurance has gone from, I think, 12,500. I just got the quote today to 19,000. And I've been able to raise rents, but nowhere close to that fast.
I bet you didn't get to double the rents.
No, regrettably. So if you guys have questions, drop them into the chat box there so we can make this a discussion. So what's the way out? So if your current loan to value is over 85%, and there were some really aggressive lenders doing that in late 21, early 22, odds are the current equity gets wiped out and it's going to get foreclosed on, and the bank's probably not even going to get their loan value at the foreclosure auction. So if you find an asset like that, if you can figure out who the lender is, start building a relationship with the bank, saying, hey, I'll take this off your books at the right price once you get through the foreclosure process. That's probably the single best opportunity set that's out there. Extended pretend is just the bank. Let's say that the mortgage is at a favorable rate and it's going to expire on July 1, and the lender is talking to the borrower, and you see that, well, gosh, I am able to make my debt service today at my current favorable interest rate, but if you raise me to 7.5%, which is market, I'm going to be short a couple $1,000 a month, and I've only got 20 grand in the operating account. So in 10 months, I'll be out of cash and I'll be in default. Not exciting for a bank to have a defaulted property. So what they have the option to do if they want to, as a small local bank, is they can extend on the current loan terms. And they might give you 3 months or 6 months, or maybe they put you to interest only for a period of time and they don't amortize. So they can extend and pretend for a while, hoping that either SOFR, the short-term rate, or the federal prime rate will decline, maybe enough that you could refinance next year and you would be okay on your debt service. So that's extended pretend. So a lot of banks who can do that probably will be doing that. The problem is that a lot of people who've got a loan, it's not with a small local lender like First Bank. It's a collateralized loan, and those guys don't have any flexibility in their rules. So extended pretend is not an option for them. So I'm not sure if the interest rates are going to decline all that quickly. Personally, I don't think they are. I mean, Joe, what do you think about rates?
I think that we're in for a long-term between 6.75 and 7.5 for, residential, and commercial can, track on either side of that by 0.25%. Anybody that's hoping for rates to go down in the next year, I think that may not come true.
I think that's probably the case. So if you are looking at buying a commercial asset and you're talking to the seller, and this is the situation that they're in, I would just stay close to them, because odds are sooner or later they're going to get in trouble. Unfortunately, the answer is probably not going to be to buy from the seller. Even if the seller gets wiped out, they get no equity, they take a zero at closing. Unless they're bringing cash to closing, it's probably not going to be attractive enough for you. The seller probably needs to be wiped out, bring some cash to closing, and then whatever the bank's remaining loan balance is, they're probably going to have to take a haircut on that of 10 to 15% on top of it. And that's probably going to be your buy price. And you're going to be extremely excited at the deal that you put together by doing that.
Hey, Lon, can I ask you a question on that?
Yeah.
Is Ironton looking at any distressed asset purchases? I don't know if we've ever spoken about that on another webinar. Is that part of the investment model for Ironton?
It's not. We don't do products directly. We work with sponsors. But what we have done is we've had sponsors that were in a situation sort of like this situation, but they're not in severe trouble. They're just a little bit short. So a good example would be you buy an existing asset that's 40 years old. It's been neglected. It's got a lot of deferred maintenance, and you have to spend a ton of money renovating all the units, fixing all the deferred maintenance on the roofs, put in a new management team, and then you raise the rents by say $500. So you execute on your plan. I'm going to renovate all these units in 24 months. I'm going to raise the rents by $500, and my cash flow is going to go from X to Y. And you execute the plan perfectly, and you can go out and see this property. It's 27 months since they purchased it, and they've been done at their project for 3 months now. What's hurting the best performers, and these are the ones that we love, is that they had an interest rate reserve for when they finished the project up of a certain amount of time, and they thought interest rates were going to go up. So they started the project at 4% interest. Now they're paying 9% interest or whatever it is. When you finish off your project and you're at this great new high cash flow, you've got to let the thing season for a while. 6 months at least, 12 months is better. And if you go to the lender, particularly if it's like Fannie or Freddie, with what's called a T12, a trailing 12 months of financials shows really high rents. It's not an aberration. It's month in, month out. I'm getting these great new numbers compared to the past. Here's my cash flow. Then they can give you a really great loan. So the challenge you might find is that you're 3 months past the completion of all the work. You've done all the value add, and the amount of interest reserves you've got left is worth 3 months, and you're on this 9% rate. It's the most frustrating situation on the planet because you need another 6 months of interest reserves to get to the finish line, and you just don't quite have it. So we've helped out in some situations like that. So what'll happen is the sponsor will do a capital call to all the limited partners, and 70% of them will fund the capital call to bring some more interest reserves to get to the final finish line. But 30%, for whatever reason, they don't answer the capital call. Either they don't have the cash, or they're stubborn, or whatever reason they don't do it. With some of these sponsors, the language is written such that if you are receiving a capital call and you don't fund it, your profit share is diluted. So usually what happens is when the deal sells, everybody gets their initial investment back, and then there's this pot of profit that needs to be divided up. And there's a formula called a waterfall that splits the profit between the sponsor running the project and all the LPs. And usually what happens is the LPs that waive the capital call, as a result, waive profit participation, or they waive almost all of it. And for the rescue capital that comes in at the last minute, let's say that you're 5% of the total equity in the project, you would get 5% of the profit pool, but you would also take the profit pool of all those people who did not fund their capital call. So the result for the person coming in, this is what we do, is that we're not coming in on month 0. We're coming in on month 27. We're not coming in at the beginning where, well, we think we can raise the rents $500, but we're not sure. It's just, here's our data set as evidence. We're coming in when the rents have been raised. We think we can get all this construction done and it'll look like this. We think it will cost this much. We think the construction will take this long. A lot of risk. I want to come in when all the construction is done. I can walk it. I can see it. I can see what you paid for it, and it's all been completed. I'm not taking any risks at all, and I'm going to make about 3 times as much profit as the people who are in on day one. I like projects like that. So yes, we invest in things like that.
Very smart.
Yeah, it's fabulous. And it's good for them too, because if the next option is like, well, if we don't raise this last little bit of money, we'll go into foreclosure. We'll be too much shy of the finish line. So it's still worth it for the sponsor to do it. So
it's like a last in, first out profit strategy. Very, very intelligent. I like it.
Yeah. So if you guys are interested in that, reach out to us in investor relations. We'll tell you about that. So construction costs are still going up, but not as fast. So some charts on that. So I think, is that actually it? It may be. So I guess what I want to do is I'll just share a testimonial with you. I've helped a lot of active investors that owned rental properties who were frustrated sell their properties and get into a passive portfolio with us so they can enjoy cash flow without the headaches. And we've got tools to manage your tax exposure when you sell, so it doesn't have to be a huge disastrous tax event while you do it. So let's just turn this over to you guys and let you answer some questions, or ask me some questions so that I can try to provide some extra information to you.
So here's a good one from Jason. With regards to IRR, is it reported over the life of the project, or is it an annualized number?
That is an annualized number after all expenses. So that would be the net to the limited partner. You being the limited partner.
Mm-hmm. And
Great
Lon,
question.
do you mind walking us through this slide that you've got here, the multiple paths? Maybe tell us a little bit about, the NDF funds, the short-term funds, the medium-term, and the single asset funds. Like, what would be maybe the pros and cons of each one?
Yeah, so we've got a couple different ways we can help investors out. So the one in the middle is called short-term income, and that's really liquid. So you can put money in and get it out on really short notice. So for example, you might own a large apartment complex and you're saving $2,000 a month because you've got to repave your parking lot and you've got to change out your boiler. These are things you have to do sometime in the next 5 years, but you don't know exactly when. Short-term income fund is a great choice for that because you can make 8 or 9% instead of 2% with Wells Fargo, and yet you can get the money back, when it is that you need it. So that's a nice fund. It's treated as a REIT, a real estate investment trust, which is a lower tax rate for most people. The medium-term income fund is just to the right of that. And this pays between 11 and 13%. So it pays more than short-term, but it's not quite as liquid. There's no access to it for the first year, and there's quarterly access after that. So if you're willing to have a little less access to the money, we can pay you a little bit more. What's nice about that is that's mostly in medical receivables. And what I love about medical receivables is that people get sick and people get in accidents at the same pace, whether it's in a recession or a boom economy, whether it's a Republican or it's a Democrat. People get sick and they consume healthcare at the same pace no matter what. It's not related to real estate, which is really, really nice. The first thing on the left-hand side is our National Diversified Fund. So that's our long-term investment fund. So our goal on that is to deliver 17 to 20% per year returns, but there's no liquidity. The money's just tied up. So what we're doing with that is we're either building new projects or doing heavy renovation of existing projects. Those are pretty substantial, meaningful, projects that take a little while to do. And then occasionally, and diversification wise, usually we make about 10 investments. There'll usually be about 40 different buildings in one fund. So there's a lot of geographic diversity. We'll invest not only in multifamily, but also in warehouse, student housing, self-storage, hospitality. So we try to spread out the risk. Just like if you were to buy stocks, you probably wouldn't put all of your savings into Apple. You'd probably put it into the S&P 500 and get a broad index. Takes a lot of the volatility out of your returns. And then we do occasionally offer single asset funds. I do have demand where, hey, I just want to invest in one project. So for example, we bought a 32 unit on Samuel Drive in Westminster in Denver about 2 years ago. Been totally neglected. We did a top to bottom remodel. We raised the rents just about $500 a door. We're just about to list that property. And that was a single asset investment where you had the opportunity to actually just invest in this one thing. So no diversification. Really easy to understand. We actually did some tours so you go see it and watch the progression as we went through it. It was actually kind of fun to watch all that. So depending on your needs, you might need a mix of these. But great question. Thank you for asking that.
Yeah. Can I ask you one more question? The medium-term income fund, I think this is really neat that it's based on medical receivables. So let's say I'm an investor and I've got 80% of my net worth is tied up in real estate. And I would never ask you to make a prediction on what's going to happen, but could it potentially be a smart thing to think about of, hey, maybe I'm going to take a slice of my net worth and put it into medical receivables because it's not correlated with real estate in any way, regardless of what the real estate market does, this is likely to perform. Would that be a smart thing to think about?
Most investors, it would. when you buy stocks, you wouldn't want to buy just high tech. You'd want to get some healthcare and basic manufacturing and other types of services, because not all facets of the economy do equally well at different phases of the economic cycle. So if you've got a blend, you can have predictable income across all of them and have a little bit less risk because of the diversification. So right now, we've got a lot of really profitable projects that we've either built the apartment complexes, we've done a heavy renovation, but it's not a very favorable time for us to be able to sell them because the interest rates are high and the buyers can't afford to pay us top dollar. So we're holding on to our assets longer than we'd like to in Fund 1, 2, and 3. So the increase in interest rates has made my first couple funds several years longer than we initially planned on. So if you had all of your eggs in that basket and you needed some of that cash now, that would be kind of a frustration for you. As opposed to if you diversified some of it into, say, the medium-term income fund, on a quarter's notice, you give us, hey, I need to get this many dollars out of my MTI fund, we can get the money out to you. So I think it's two things. A, it's not in real estate, it's not sensitive to interest rates, and two, it's got some liquidity attributes that our long-term fund doesn't. You need a little bit of both. Great question. Depending on your age and your financial goals, you'll need a different blend, of course.
Yeah, and I think it's really smart what you said. The medical or the medium-term income fund is not correlated with interest rates either. It's basically a completely separate bucket from real estate. Very smart.
Yeah, I mean, eventually rates will go down. I don't think it's going to happen very much this year. I think it's probably a next year thing. But the returns that we get probably shouldn't fluctuate a whole lot.
I agree.
So if you are interested in learning more, here's the URL you can go to, and we'll try to help you out. So several times a week, I'll talk to an investor who's got a rental property that, the tenant is going to be expiring on their lease soon, and they're trying to decide, do I renew the tenant, do I get a new tenant, or do I sell? What I can help you do very easily is show you, here's the wealth your family will create over the next 5 years if you stay with this rental. If you sell it and pay the capital gains and put it in the stock market, here is what your wealth appreciation is going to look like. If you sell it and pay the taxes and invest with us, here's what that looks like. And then I can give you all of the facts you need to make an informed business decision with your family about what the right option is. So this is where you sign up to do that. And always happy to help. And you'll probably think of 5 more questions once we finish up our webinar. I can answer those while we're on the phone together too.
I think one other thing on this, Lon, we've got a webinar next week. In addition to selling an asset, exactly what you just said is, hey, I've got a rental property that I've owned for a number of years. The tenant is about to turn over. Maybe I want to sell it and invest in any one of the funds or want the cash, whatever. We're actually going to be talking next week on what if you were to keep the property, take some cash out of that in the form of a home equity line of credit or in the form of a cash out refinance, and then reinvest that capital into Ironton and one of the various funds. Would that make sense? So that's something we'll be doing a webinar on next week. It's Tuesday, the 11th at 6 p.m. So make sure you guys all watch for your email for that webinar, because I think that'll be another strategy to consider.
You're totally leading with us. I was just about to bring that up. Is a lot of you have got a rental property where you were able to refinance it in 2020 at maybe 4%, and you've got a ton of equity. Getting rid of that first mortgage may not make sense. So Joe's got a number of alternatives for you that could help you access that. And we were actually just working on a spreadsheet before we started this webinar today to help you calculate, well, if I were to go borrow money on a second mortgage and invest it, what kind of wealth creation would that generate over the next 5 years? And we're building that tool so we can share that with you. So I'm very eager to get that into your hands.
All right.
Wow. We finished early. That never
happens.
All right. Well, if there are any other questions, I hope you guys will sign up, and I look forward to chatting with you over the next week or so. Thank you, Joe, for all your time today. I really appreciate it.
Absolutely. I learned a lot. Hopefully this was useful for the folks on the call. As always, feel free to reach out to Lon, reach out to myself. We're always happy to chat about this stuff, and really appreciate you guys joining us this evening.
Cool. Thanks a bunch.